In a previous lesson, we discussed what fundamental analysis does and how demand and supply affect the markets. In the current lesson, we will discuss factors that affect exchange rates. There's a high number of factors affecting an exchange rate over the short, the medium, and the long term. In this lesson, we will discuss three. We'll make a start with growth factors. Overall, countries which have economies that grow faster are often good places to invest. In such countries, there are usually more opportunities for expansion, while at the same time, rising incomes create demand. It's typical that overseas companies want to set up operations in these countries. They also want to buy companies, build factories, set up stores, while foreign investors want to buy stocks of companies operating in these countries. Basically, everybody wants a piece of the country's economic growth. These factors normally boost demand for the currency of the country and cause it to appreciate. Also, we should take into consideration a country's trade balance, which is the amount the country receives for the export of goods and services minus the amount it pays for its import of goods and services. At this point, we must note that sometimes economists make a distinction between the international transactions for goods and the ones for services. Broadly speaking though, countries that run persistent trade surpluses tend to have strong currencies. Conversely, nations with consistent trade deficits tend to have weaker currencies. Why? Because demand for the currency of a country is also highly dependable from its necessity in the international markets. If Japan exports more goods to the US than the US exports to Japan, then the demand for Japanese yens from the US increases. Therefore, the yen may strengthen against the dollar. That would cause USD/JPY to go down. Also, countries with natural resources earn foreign exchange by exporting them. That would lead practically to an appreciation of the value of the currency. It's understandable that the market also links the value of the natural resource to the value of its currency in a linear manner. When the price of the natural resource that they export goes up, the value of their exports goes up, and the currency may appreciate as it may anticipate more demand. Vice versa, when the price of the resource they export goes down, the currency depreciates. Classic examples in the FX market of such relationships are the Canadian dollar and oil, Australian dollar and iron ore, New Zealand dollar and dairy products. In the next lesson, we will discuss monetary policy and inflation as the two are interlinked.